Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden truths behind financial reports. And today we're diving into Extra Space Storage Inc.'s Q3 2025 report. Think of it like getting a sneak peek behind the curtain of a company that manages a ton of storage units. So what is this document all about? Well, it's a quarterly report filed with the US Securities and Exchange Commission. Companies use these reports to keep investors updated on their financial health and operations. This report covers the period ending the 30th of September 2025. If you're into knowing where your money might be going or just curious about how big companies operate, you'll want to stick around. And hey, if you appreciate these deep dives straight from the source, make sure you are subscribed and join our Discord community linked in the description below for even more insights. Alright, let's jump right into the numbers. This first table, the condensed consolidated balance sheet, is like a snapshot of the company's financial standing on a specific day. Picture it as the company's financial x-ray. On the 30th of September 2025, Extra Space Storage Inc. had total assets valued at a whopping $29.2 billion. Compare that to the 31st of December 2024, when their assets were around $28.8 billion. That shows a good increase in what the company owned. Now, a huge chunk of that is in real estate assets. As of the 30th of September 2025, these were valued at nearly $24.9 billion. That is the core of their business, owning storage facilities. They also have significant investments in what they call unconsolidated real estate entities. Think of these as partnerships or other companies they invest in but don't fully control. These investments were worth over $1 billion. But owning all that stuff comes with debt. The total liabilities for Extra Space Storage Inc. on the 30th of September 2025 were about $14.7 billion. A big part of that comes from unsecured senior notes totaling nearly $9.5 billion. That is a lot of borrowing. When you look at the whole picture, total assets were $29.2 billion and total liabilities, and equity were also $29.2 billion. This means the company owes out a roughly equal amount to what it owns. Now let's talk about how much money they made and spent. The income statement or statement of operations tells us about their performance over a period. For the 3 months ending the 30th of September 2025, their total revenues were $858.5 million. That's up from $824.8 million in the same period in 2024. Pretty good growth there. The main moneymaker is property rental, soaring to $735.6 million for the quarter. That shows their core business is performing strongly. Tenant reinsurance also brought in a decent $90.3 million. But running all these properties costs money. Total expenses for the quarter were $474.2 million. The biggest chunk here is property operations at $235.5 million, followed closely by depreciation and amortization at over $177 million. So after all that income and all those expenses, what was the bottom line for the third quarter of 2025? The company reported a net income of $174 million. That is down a bit from $202.9 million in the same quarter of 2024. This translates to earnings per S-share. For the quarter, basic earnings per S-share was $0.78. That number is the same for both 2025 and 2024 in this report. Diluted earnings per S-share also stayed at $0.78 for both periods. Looking at the bigger picture, for the first 9 months of 2025, net income was $721.7 million. For the same period in 2024, it was $622.4 million. So for the year so far, they've actually made more money than last year. That is a positive trend. Okay, so we've seen what they own and how much they earned, but where did the cash actually come from and go? This is where the cash flow statement comes in. For the 9 months ending the 30th of September 2025, the company generated over $1.48 billion in cash from its operating activities. That is very strong and slightly up from $1.47 billion in the same period of 2024. But when it comes to investing, they spent a lot. They spent nearly $588 million on acquiring real estate assets and improvements in the first 9 months of 2025. This shows a big push to expand their property portfolio. They also invested over $107 million in unconsolidated real estate entities. On the flip side, they did sell some assets, bringing in over $168 million in proceeds from sales of real estate assets. This is a significant increase from just $4.4 million in the prior year, which suggests they are actively managing their property portfolio, either buying more and selling some or selling older non-strategic assets. Financing activities show how they manage their debt and equity. For the 9 months ending the 30th of September 2025, they used over $811 million in financing activities. This included paying down a massive $12.7 billion on their various loans and credit lines, while also issuing new debt like $1.65 billion in public bonds. And of course, they paid out dividends to their shareholders. Shareholders received over $1 billion in dividends for the 9-month period in both 2025 and 2024. That shows a commitment to returning value to investors. Now, for the really detailed stuff, the notes, this is where they explain all the accounting terms and the nitty-gritty behind the numbers. The company uses derivative financial instruments, primarily interest rate swaps, to manage interest rate risk. They explain that these valuations mostly fall into level 2 of the fair value hierarchy, meaning they are based on observable market data. But they also mention that credit valuation adjustments, which consider the risk of a counterparty defaulting, use level 3 inputs, which are unobservable and require more estimation. However, they state these adjustments were not significant as of the 30th of September 2025. Here they detail their property buying and selling activity. For the first 9 months of 2025, they acquired 46 wholly owned stores for $310.7 million. They also assumed nearly $258 million in loans. During this period, they disposed of 12 wholly owned stores. This shows a consistent strategy of acquiring and selling properties to manage their portfolio. This section talks about properties they intend to sell. As of the 30th of September 2025, they had properties worth nearly $194 million classified as held for sale. They recognize significant losses on some of these properties, indicating a strategic move to exit certain holdings. This is a big one detailing their loans and bonds. As of the 30th of September 2025, their total term debt was over $12.2 billion. A large portion of this $9.67 billion is in unsecured senior notes. They also break down debt maturities, showing significant amounts due in the coming years, which is important for understanding their future financial obligations. They also have significant access to credit lines. As of the 30th of September 2025, their revolving lines of credit and commercial paper capacity was over $4.1 billion with $942 million drawn. This provides them with flexibility to manage short-term cash needs. This is a key metric for real estate companies. Funds from operations, or FFO, is a measure that gives a better picture of a REIT's operating performance than net income alone, because it adjusts for depreciation and gains or losses from property sales. For the 9 months ending the 30th of September 2025, Extra Space Street Orage Inc. reported FFO of $1.31 billion. That is up from $1.24 billion in the same period last year, which is a very positive sign for their operational health. Looking at their existing stores, those that have been stabilized for a while, the numbers are interesting. For the 3 months ended the 30th of September 2025, same store rental revenues were flat at essentially 0% change, $673.9 million, compared to $675.3 million in 2024. This suggests that their core mature properties are maintaining their revenue levels without significant growth or decline. However, same-store net operating income, which is revenue minus operating expenses, saw a 2.5% decrease for the same quarter, falling to $477.2 million from $489.3 million last year. This hints that while revenues are stable, operating costs at these same stores might be creeping up, or that they are strategically using pricing to maintain occupancy. So what is the overall picture this report shows? Extra Space Storage Inc. is a massive company with a strong core business in self-storage. They are actively managing their property portfolio, buying and selling to optimize their holdings, and they have substantial access to credit. While net income for the quarter was down from last year, their 9-month performance has improved, and their funds from operations, a key metric for REITs, is showing solid growth. The flatness in same store revenues coupled with a dip in net operating income for those same stores suggests a need for vigilance in managing costs or carefully evaluating pricing strategies. Their significant debt levels and reliance on credit lines are always a point to watch, but their strong cash flow from operations and dividend payouts are reassuring signs for shareholders. Overall, they appear to be navigating the current market conditions with a mix of expansion and strategic property management. Alright, this was our deep dive into Extra Space Storage's Q3 2025 report. What are your thoughts on these numbers and what they mean for the company's future? Let us know in the comments below. If you found this analysis helpful, please hit that like button and subscribe for more corporate breakdowns. Don't forget to join our Discord community for continued discussions. Thanks for watching, and we'll see you in the next video.